Hello everyone, it's James Woodburn here. I'm the publisher of Fat Tail Investment Research. Now, welcome to my discussion today with Ryan Dinse. Ryan is our tech and crypto investment expert and the author of the Monday edition of Fat Tail Daily. How you doing, Ryan?
Yeah, good, Woody. How are you?
Yeah, good, mate. Good. Look, I thought we'd just get on camera and discuss a few of the key points in today's article. I thought it was really interesting. You gave us a lot to think about regarding the US Fed's recent pivot on interest rates, the potential market reactions, and a couple of investment strategies in light of these developments. So I thought we'd just dive a little deeper into the key points that you raise. Now, let's start with what you call Powell's Pivot. Now that sounds a little jargony, but you're talking really about the move from rate rises and that being strategy to holding rates high to then pivoting to be more with a view to cutting rates. Now, how do you also say that this is quite odd because you've got lots of economic data points suggesting that things are a lot better. So why would you cut? But it's actually the real story is in the job market. Do you want to explain a little further?
Yeah. So the Powell Pivot sort of refers to the Jackson Hole meetup that happened over the weekend, which is every year, once a year, all the Federal Reserve members, which are actually members of private banks in America. People maybe don't understand that the Federal Reserve is a private institution. It's not a public institution, but that is the institution in America that sets interest rates, much like the RBA, the Reserve Bank of Australia, does here in Australia. So anyway, every year they meet up at Jackson Hole and they call it the Jackson Hole Conference, and the whole global markets watch that event to see what they're saying, see what the directional interest rates are, and just generally try and get a feel for what the central bankers will do next. So the big news from the weekend was that Jerome Powell, who's the chairman of the Fed, came out and basically said we are going to start cutting rates. So for a long time, if you think about the last 12 months, the central banks all over the world have been raising rates in a fight against inflation. So they've been saying, look, prices are rising too fast. We need to increase rates to stop spending in the economy and try and bring down those price rises. And they've been saying that pretty consistently all along. So when I talk about the Powell pivot, it's more of a pivot, one, in the direction of interest rates, which are now clearly coming down, but also in the sort of messaging that he gave. Because what Jerome Powell gave as the reasons, like you said at the start, there's a lot of, right now anyway, the current data looks quite good. Stock markets are high. Employment figures, although they're deteriorating, they're still pretty good. Credit spreads, which are a sort of indication in the markets of how worried the market is about, credit defaults and things like that. That's generally all okay. But what Powell said for the reason for cutting rates was that he is worried about jobs, worried about a deterioration or a fast deterioration in the job market. So it looks like the pivot is the focus has turned from inflation, which for now at least they say that's maybe a battle they feel they've won, to okay, the jobs market's getting worse. We need to deal with that, and so it was sort of like it was a turning point in their messaging. So even if markets thought this might be coming, I mean, markets have been pricing interest rates before this event. This was sort of the confirmation that they need to. If you think about the economy, it's like this big slow-moving ship. When you increase rates, it takes time for the effects to play out. There's a lag, but the opposite is true when you cut rates as well. So if you're worried about job losses 6 months from now, you need to start turning the ship around now. So I think that's what the indication we've got is that the Fed is maybe trying to stick this soft landing that they talked about. So rather than wait for a recession, which is what they usually do before they cut interest rates, they're trying to maybe cut rates ahead of that and sort of stick this narrow soft landing approach where the economy doesn't go into too bad a situation before they start cutting rates. So that's the Powell pivot.
soft landing and hard. I love it when the powers that be try and manipulate things that it always ends up making some kind of problem worse, doesn't it? But you mentioned also that there's a lot of money, there's a lot of dry powder in money markets accounts. So that's like a big, essentially trillions of dollars in cash just waiting to move into risk assets. What's the risk of that? What happens when that moves Is that not going to spike inflation all over again?
Maybe not. Look, it's the 6 point, like you said, there's a record amount of cash sitting in money market funds, which are just like cash-like instruments, and it's $6.24 trillion worth, and it's been increasing over time. And if you think about it, that makes sense. Over the past year, a lot of investors are happy getting 5% returns in US Treasuries, which is like having money in the bank. It's the safest place you can put it, or in theory at least, it's the safest place you can put it. And so they were earning 5% on that. I'm pretty happy with it. But as interest rates come down, that money tends to rotate into riskier assets because it makes less sense to hold money in cash if it's earning closer to 3% than it does if it's earning, 5 or 6%. So I don't think it will impact inflation, but what it might do, and what I sort of alluded to in the piece today, was that it might find its way into stocks. So even though we're not far from all-time highs, we might see money rotating back into stocks on the back of people saying, well, interest rates are coming down. That generally stimulates, the stock market. It can stimulate the economy because you have to understand when the Fed reduce rates, what they're doing is allowing more money to come into the economy, which should support, companies' general spending and other things like that. But it also shifts investors' behavior as well. So there's two sides of that. And so if that happens, the stock market is a natural beneficiary of that. That's not without risks. And I sort of said that in today's piece as well, is that the worry that some people have is that, does that stoke inflation again by putting more money into the economy? It could do, who knows? But also, is the fact that they're now cutting rates so fast an indication that they do think things are going to get a lot worse and we could be in a recession? And I think I wrote about this a few weeks ago, saying that one indicator called the SAM indicator, that is an economic indicator on employment, suggests the US is already in a recession. So maybe the Fed's just catching up to that fact and trying to get ahead of that. Look, I would prefer not to be spending all my days talking about central banks and what they're doing and what they're not doing. And I think that's an indictment on the system. The bigger picture is this is an indictment on the system we've created, where fortunes rise and fall on the back of a meeting of 12 or a dozen people in America and what they say they're going to do. So I think that's the bigger picture that's more concerning to me, but it is what it is, and as an investor you sort of have to play the game as it is, not as how you want it to be.
Well, talking of how you want it to be, there are some potential solutions to all this, and where you think that would be good an investment trend for your money. But before we just finish on that, you do draw parallels between the current situation and the inflation-riddled era of the 1970s. What key differences do you see between now and then that might affect how inflation plays out this time around? Because if you remember, there was a big blow off top. Maybe is that something you see coming, or?
Look, I'm not an expert on the 1970s, so I'm not going to try and hazard a guess on that. I know the era of the 1970s was a little bit different than today, given the fact that we're a lot more technologically driven than we were back then. The biggest companies back then were probably more like banks and oil companies. You did have tech companies that rose during that era as well, but today, the innovation in tech is a lot faster and a lot more prevalent in the economy. And the thing you've got to remember about tech in general is that it's a deflationary force in the economy. Yep. You buy an iPhone now, the iPhone you bought 2 years ago sells for like 10% of the price. Computers get cheaper over time for the amount of processing power you have. All technology gets cheaper over time, so that's deflationary, and that's really important to understand. So, but central banks don't like that, so they try to create inflation, which is ridiculous, but that's the situation as it is. And so they're always trying to fight against the deflationary forces of technology by printing more money. I would say, and this is sort of this is not I'm not like 100% saying this is what's going to happen, but in the short term, I think the rate cuts could reignite a bit of a melt up, as you said, in tech markets, because we had over the last few weeks, if you remember, we had this huge sell-off on the back of the Japanese carry trade dramas, where people started selling tech stocks because of worrying about what was happening in Japan. They had to sell tech stocks to pay off Japanese loans, basically. But then we had this huge rebound. It was, I think, my colleague Charlie Orman said it was the fastest turnaround from bottom to top in history. After immense volatility, it rose back up, and so interest rate cuts are generally good for tech stocks. We know that. The theory of that is that a lot of tech stocks make their earnings out in the future. So the cash flows aren't necessarily coming today, but they might be coming in over the next 5, 8, 6, 7 years. And when you reduce interest rates, basically something called the present value of that cash flow gets higher. When interest rates are higher, the present value of that cash flow is lower. So that's the theory behind it. The second point is the one we made earlier, which is just that, well, if people are taking money out of money market funds, they're going to look for another liquid place to put it, and tech stocks are the most liquid, fast-moving spots they can go. And the third point, which I made in today's piece, was that we've got NVIDIA earnings coming up on Wednesday. And if you remember, NVIDIA was at the heart of the AI story that played out over 2023 and the first half of 2024. And that went crazy. The rise in NVIDIA was nuts. And it sort of signaled that the AI trend was real. It wasn't just a fad. Then since July, we've had a bit of a pullback in that trend. And what I think we'll see on Wednesday is if NVIDIA results surprise to the upside and show that the rollout of all this infrastructure to support artificial intelligence future is still ongoing. If you couple that with rates cutting, you could just see the sentiment-driven rally where tech stocks go higher again, and that momentum feeds upon itself. It doesn't necessarily have to be rooted in fundamental reality, but there's risk to that. Of course, I'm not saying that's the ultra bullish scenario. Yeah. On the other hand, you've got some tensions in the Middle East occurring early this week. And you've got, I noticed this morning, the Japanese yen strengthening. So does that then result in carry trade dramas rearing up again? And that could, I don't think it will. I think the Bank of Japan have had their warning, and they will have facilities in place in conjunction with the Fed to arrest that for now, at least until the US election in September. But that's a trade idea to look at this week if people are looking at. We've actually got a trade alert going out in the Alpha Tech Trader service today, which is basically playing the idea that NVIDIA results will surprise, and we could see a little short-term bump over the next few months in AI-related stocks. If we're wrong, we've got a stop loss and we'll get out quick enough. But I think it's a decent bet right now.
Well, when we catch up next Monday, let's review what happened this coming Wednesday. Yeah, but finally, I just wanted to touch on two other ideas that came out. Well, they're part of the same. That's gold and Bitcoin.
Yeah,
I guess it's part of the same idea. You basically touched on the idea that they're, potential hard money trades in the face of this monetary easing.
Yeah,
but given their different characteristics and adoption levels, how do you see their roles evolving in a new environment of rate cutting?
So historically, what they call monetary liquidity, which is when more money comes into the system, however that is, that can be interest rate cuts or that can be government spending, debt and deficit. But however that is, that generally is good for things like Bitcoin and gold, which I've said this a million times, but you compare fiat money system to gold and Bitcoin as one's unlimited in supply, and over time the supply does increase quite a lot. And gold and Bitcoin have natural hard limits to them. There can only ever be 21 million Bitcoin, and gold became a monetary asset because there's not that much gold around. It's comparatively scarce. So generally speaking, gold is close to or at all-time highs as we speak. Bitcoin jumped pretty quickly on the Jackson Hole comments from the Powell, so that suggests that the crypto traders are saying, well, if they're going to turn on the monetary taps, I want to own as much Bitcoin as possible because that's a monetary asset that can't be debased. But you asked about the differences. The way, obviously, I'm more in line with Bitcoin. I think the pathway for gold is that potentially countries that want to get away from the dominance of the US financial system, so your Russia's, China's, your BRIC countries, they will look to store gold in their central bank vaults as potentially a means of trade settlement, so as an independent asset, rather than using US dollars, which we have in recent years, or US treasuries. I think that will be more led by central banks. Whereas I think Bitcoin offers the potential for the average person, anyone or company, which is what we're starting to see, to own an independent store of value asset themselves, which is portable. You can take your Bitcoin anywhere in the world with you, as long as you can remember, 12 or 24 words. You can buy stuff with Bitcoin. Even today, you can divide your Bitcoin into as small a unit as you want. But it has got that hard monetary quality the same as gold does, in conjunction with the convenience of fiat money, in that you can spend it digitally as you want. So I think you'll see more individuals and individual companies, and even potentially some nation states, start to adopt Bitcoin strategies as a way of preserving their own purchasing power over time, which is what gold does, and what I think Bitcoin will do in the future. So I see gold and Bitcoin as riding similar trends, but I think the potential of Bitcoin, because it's programmable, because it's digital, because it's portable, and because you can divide it. You can't, divide a bar of gold down and buy shopping with it, but
I guess you can, but it's just with much difficulty.
it'd be very hard to do, yeah. But you can do that with Bitcoin. I can buy my groceries with Bitcoin today if I wanted to. I don't, because I think the upside value of it is a lot higher than today. But in places like El Salvador, it's legal tender. Even it's you can spend it. You can go to McDonald's. You can make a transaction. It settles instantly. You're not relying on the rails of the traditional financial system. You're relying on a decentralized network. And Bitcoin is the asset that underpins that decentralized network. So coming back to the overall point of the piece, then the bigger picture is central banks will do what they do. They'll reduce rates. They'll pump money in when times get tough. They'll reduce rates for whatever reason. Maybe it's political. Maybe it's a US election. Maybe it's because they see problems down the road. Maybe it could be whatever reason. But as you sort of point out at the start, there's always these second and third order and fourth order effects which happens. And when they try and dampen volatility here, it just leads to a bigger crisis down the line. And the response to that bigger crisis is more money comes into the system. And we've seen that for the last 20 years and even 50 years. And I think in that trend, owning some Bitcoin in your portfolio and some gold makes sense as a hedge against that sort of inevitability.
And then look out for some trading ideas in the tech sector, where the money goes.
But yeah, the short term, tech sector will be interested in this week. Keep an eye on the NASDAQ. Keep an eye on NVIDIA on Wednesday. And yeah, it might not make sense to a lot of people, and they'll say it's a bubble and it doesn't make sense, but it doesn't matter. When money starts moving into a sector, in the short term at least, you can make some good trades.
Good stuff, Ryan. Well, thanks for your time. You talked a lot today in today's issue. Guys, if you're watching this via YouTube, do hit that subscribe button and we'll get a notification when a new video gets uploaded. And if you're on the Fat Tail Daily website, just look around. There'll be a sign up box if you'd like Ryan's daily email. Well, there's a daily email for the publication. Ryan's comes through every Monday. We'll be back in touch tomorrow. Thank you. Cheers, Ryan.
Cheers.